of the reasons why there's a poor financial literacy in Canada may be because of the industry approach to promoting and marketing financial services. There's a lot of industry jargon used when communicating with general Canadian population. This creates misconceptions or assumed facts that are simply not true. My name is Chow Ivanovic, member of the IB Canada Group. For example, many people often mix up the difference between saving and investing. Generally, funds allocated to savings should be allocated to safe investments. Safe investments are much like Tier 1 capital of major banks, which is low risk and safe. For banks, this is a legal requirement. It is also the requirement that banks don't like too much, since it restricts where this portion of the capital may be invested in and restricts the returns. Fooling around with this Tier 1 capital requirement was the reason why we had 2008 worldwide financial crisis. For ordinary people, in a similar way, savings is the capital that we cannot afford to lose or we don't want to lose. It is meant to be saved for important future expenditures like children's educations, down payment for the house, retirement, etc. People want to warehouse the money in a place where it is safe, liquid, and accessible. On the other hand, investing assumes that you can afford to and to take risk with a possibility of a loss to enhance your returns. In the financial industry today, when people talk about a retirement savings plan, plans they generally refer to are structured as investment plans. These plans often involve market risk over which individual investors and savers have no control of. Further, investors pay all the fees and taxes, endure exposure to market volatility and other market risk. This is not an ideal solution for the majority of the Canadians. We should have an option to warehouse our money in a place where our money is safe, liquid, and accessible. If it can also be growth tax shelter and enjoy uninterrupted compounding growth, even better. Let's talk about tax brackets and RRSP. The government offers Canadians the opportunity to put pre-tax dollars into the RRSP and have those dollars grow and earn investment income without being taxed on an accrual or as earned basis. Individuals get to deduct their contributions and defer taxes on the investment growth. In promoting this strategy, an assumption is made that you will be in the lower tax bracket at the time when you retire and start drawing an income from your RRSP. All these perceived immediate benefits make this strategy appear very attractive upfront. Relentless promotion of the strategy by major Canadian financial institutions contribute to widespread use of RRSP by Canadians. Now, let's take a closer look at how are the elements of this strategy put together. Most Canadians believe that RRSP are tax deductible, but that's a misconception. RRSP only defer tax. You pay the tax when you take your money out. So it's a tax deferral device, not a tax deduction device. In promotion of this strategy, there's rarely a proper explanation of the full impacts of building an RRSP to an individual. It almost appears as though there is a hidden agenda. Taxation levels in any society are set by respective governments. So it appears that registered plan is a government solution for a problem that government created in the first place. Individuals should understand the full tax consequences. Registered plan is simply a tax postponement because rather than dealing with the effects of taxation upfront, the system encourages people to kick the can down the road and postpone both the calculation and payment of taxes. The analogy we often use is, if I give you the choice of being taxed on the seed or the harvest, what would you choose? I believe most people would say the seed. But the registered plan is based on the opposite. Let me unpack a bit more of why RRSP are a solution to a tax problem that government created, but they are not necessarily a wealth solution for Canadians. There are a few things people need to be aware of when they put their hard-earned money into these plans. First, you give up control of your money, which means that You are unable to take advantage of opportunities that come along or to handle emergencies that might arise because your money is locked up in your registered account and you cannot access it without a penalty. Second, you will have to pay taxes on both the original contribution and the growth of your money at some time in the future. Back to my previous analogy, rather than pay tax on the seed, you pay tax on the harvest. You have no control of what the tax rate will be in the future. You will have to pay tax on whatever the tax rate is going to be based on whatever marginal tax bracket you are in at that time. Even worse, you are forced to take the minimum withdrawal out of your RRSP and pay taxes on that additional income when you reach age 71. Withdrawal amounts are added to your gross earned income and taxed as ordinary income, even though they may consist mostly of capital gains and dividends collected over the years. Ordinary income is taxed at a higher rate than the preferential tax treatment given to investment income earned from capital gains and dividends. And the entire balance of your registered accounts is taken into your income in the year of death, virtually guaranteeing the government that you are now well above threshold from the top marginal tax bracket, and you are nearly guaranteed to be in at least a higher tax bracket as you are today, or at least it is highly unlikely that you will be in the lower tax bracket, or that your tax rate will be lower by the time you retire. Why I am so certain that taxes will increase in the future? The Income War Tax Act was introduced in Canada in 1916 for businesses and 1917 for individuals as a temporary measurement to help the World War I efforts. It was only 10 pages long at that time. Fast forward to today, it's more than 3,500 pages long and growing. More importantly, the nature of Canadian income tax system also changed. In 1917, Income War Tax Act exempted the first $1,500 of income, about $30,000 in today's dollars, from any tax whatsoever. The top rate of 25% back then applied only on income over $2 million in today's dollars. Currently, the top federal marginal tax rate of 33% now kicks in at $220,000 in 2022. See where this is going. Another point that generally escapes Canadian population is that we live in a mixed economic system. Most Canadians like to think that we live in a free market economy. That is simply not true. Canada has a mixed economy, positioned between the two extremes of capitalism and communism. The three levels of government decide how to allocate much of the country's wealth through taxing and spending. Tax system today is used for social, economic, and political objectives. These are not my opinions, but realities. Canada's aging population, increasing healthcare costs, and government debt are all easily verifiable facts. According to the research done by the Fraser Institute, government revenues will be flat. But with more baby boomers retiring, working less, and earning less, simple math indicates that expenditures are increasing and will most likely continue to do so in the future. The only way for government to deal with all these problems is to raise taxes. As of today, Canada's federal debt is more than $1 trillion, or 1 with 12 zeros at the end, which is far beyond our ability to comprehend, and the debt is increasing by $144 million a day. Higher debt today could mean higher taxes tomorrow. Who's going to pay for it? Taxpayers, of course. Do you still think you will be in the lower tax bracket when you retire? If government really wanted to help, all they had to do is reduce taxes. When government creates a tax problem and turns around and provides us a solution to the problem they created, how do you feel about it? A little bit suspicious? Perhaps manipulated? Dealing with a hidden agenda? Currently, there are really only 4 tax shelters left in Canada. One of them is a principal residence, at least for now, although they are looking at changing that. The second one is a TFSA. Investment income in your TFSA is tax-free, but the amount you can deposit every year is very small and limited. The next one, lottery winnings. In Canada, lottery winnings are still tax-free. The last but not least is life insurance. The reason why life insurance still has tax preferential treatment is the fact that life insurance contracts exist 70 years before the Income Tax Act was introduced. By virtue of its prior establishment, insurance contracts were grandfathered into a tax-exempt status and to this day enjoy preferential tax treatment and is protected by the Income Tax Act. As members of IB Canada Group, we have joined forces to share the message about alternative approach to personal finance. We are a group of like-minded advisors who share the similar principle and similar ideology, trying to raise awareness across Canada from coast to coast about the advantages of taking control and taking responsibility of one's personal finances. This doesn't mean we have a solution that fits all. We are simply inviting people to take a look at what they can accomplish if they have a different attitude and mindset towards personal finance. And probably most important part of our message to all Canadians is take ownership of your personal finance, understand the system, and make informed choices. The system will always take care of the system anywhere in the world. You need to exist in that system and take care of yourself. We are empowering people to understand and gain control of their own finances through a process. Infinite banking strategy is an opportunity to regain control of one's financial functions. Among other things, it is a way to recapture the interest normally given away to other financial institutions. Invest safely, borrow at lower rate, and lend out at a higher rate. The principle works for banks for centuries, but anyone can be a little bit of bank themselves. Apply the same principle and become your own personal banker.